Hello everyone, welcome to Brilliant Bankers. In today's session, we will be discussing about Module B, that is 50 MCQs from Module B of Indian Economic and Indian Financial System, the subject of JAIIB. Module B comprises of the economic concepts related to banking. So let's start. Question number 1. Which statement best defines money supply in India? A. Currency with public plus demand deposits plus the time deposits. Those are in the banks. The currency with banks only, high powered money only, or the currency with the RBI. Which statement best defines the money supply in India? M3 money supply in India. So the right answer will be A, that is M3, which is the broad money. It includes cash and the deposits, both the demand and the time deposits. So it is a key indicator for RBI's monetary analysis. Coming to question number 2, the velocity of money refers to what? Growth rate of money supply, frequency at which money circulates in the economy, inflation rate, or D, the interest rate spread. And the right answer will be frequency at which the money circulates in the economy. That is, velocity means which is the total GDP divided by the money supply. So higher the velocity, money changes hands faster, and there is inflationary pressure. So whenever there is high velocity, the money changes the hands faster. So answer is B, the frequency at which money circulates in the economy. What is question number 3? Open market operations, the OMO, are conducted by which of these? The SEBI, RBI, Ministry of Finance, or the SIDBI? And the right answer will be RBI. RBI buys or sells government securities to adjust the liquidity, which is a major monetary policy instrument. So open market operations are conducted by RBI. Coming to question number 4, which of the following correctly states the credit creation process of the banks? Banks destroy money by lending. Banks multiply deposits through lending. Only RBI creates credit, or the depositors lose funds when banks lend. Which one of these is correct? I think everyone knows the definition of a bank. So as per that, each loan becomes a deposit elsewhere, or each deposit becomes a loan elsewhere, which creates multiple rounds of money. So banks multiply deposits through lending. The answer is B. So this is key for understanding the monetary expansion. Each loan becomes a deposit, and each deposit becomes a loan, creating multiple rounds for money. Coming to question number 5. The Liquidity Adjustment Facility, the LAF, primarily aims to which of these? Control government expenditure, manage short-term liquidity in the system, regulate the FDI, or support rural finance. What is that? And what does LAF have or include? It manages short-term liquidity in the system. LAF includes repo rates, the reverse repo operations. So it includes the repo and the reverse repo operations. It helps RBI maintain the overnight liquidity balance. Coming to question number 6, a rise in CRR, the cash reserve ratio, leads to what? Increased bank lending, reduced liquidity in the banks, more currency circulation, or there will be no impact. What happens? And the right answer will be option B, reduced liquidity in the banks. Higher the CRR, higher the cash reserve ratio, there will be less lendable funds. So this is a contradictory effect on money supply. whenever RBI increases the CRR, banks have to have that reserve with RBI so that they don't have any liquid funds for circulating in the name of loans. So there will be reduced liquidity in the banks. Which concept best explains the inverse relation between bond prices and the interest rates? Which concept best explains the inverse relation between bond prices and interest rates? Is it the demand law, the time value of money, the Fisher effect, or the present value principle? Which one of this is? And the right answer will be option D, present value principle. When rates rise, the present value of future cash flows falls. So automatically the bond prices decline, which is a key market dynamic. So whenever there's a rise in the rates, the present value of the future cash falls. So the present value principle is the right answer for this. Coming to question number 8, which of the following is a leading indicator of economic activity? Is it the inflation rate, the stock market index, the unemployment rate, or the fiscal deficit? Which of the following is a leading indicator of economic activity? And the right answer will be option B again, wherein the markets react ahead of real sector data. The stock indices often signal upcoming expansion or a slowdown. Coming to question number 9, what is the main purpose of marginal standing facility, the MSF? Does it provide long-term refinance? Does it allow banks to borrow overnight above the repo rate? Does it support government borrowing, or does it manage the fiscal deficit? So what is that? MSF, marginal standing facility. Marginal standing facility is the emergency overnight borrowing window for the banks. Acts as an upper bound of RBI's policy corridor. So it is option B. It allows banks to borrow overnight over the repo rate. Starting the next question, question number 10. When the rupee depreciates, export becomes what and imports become what? When the rupee depreciates, exports become dash and imports become dash. Is it costlier and cheaper? Is it cheaper and costlier? Does it stay unchanged or does it become costlier? Whenever there's a depreciation in rupee, export becomes cheaper and imports become costlier. That is, depreciation makes Indian goods cheaper abroad, which boosts exports, but imports become more expensive, which affects the balance of payment dynamics, the BOP dynamics. Coming to question number 11, the Phillips curve shows the relationships between what? Inflation and employment, savings and investment, interest rate and money supply, GDP and fiscal deficit. Which one of this is the answer? The Phillips curve. It shows the relation between inflation and employment. So the right answer will be option A. So when unemployment falls, inflation tends to rise, though the link weakens in a long run. Coming to question number 12. Which theory explains how interest rates are determined by demand and supply of money? Which theory explains how interest rates are determined by demand and supply of money? Is it the quantity theory, the loanable funds theory, liquidity preference theory, or the purchasing power parity? What is it? So the option answer will be option C, liquidity preference theory. Mr. Keynes proposed that people hold money for transactions, precaution, and speculation, determining the rate of interest. So the interest of rates are determined by demand and supply of money. So this is said in liquidity preference theory. Question number 13. Which of these best describe stagflation? So what is stagflation? I think all of you are clear with that. It is high growth plus high inflation. It is low growth but having high inflation. It is deflation and having an expansion, or a balanced growth. So what is stagflation? Stagflation is a condition when there is low growth with high inflation. So stagflation combines stagnant output with rising prices, which was normally seen in the 1970s global oil shocks. So that is called stagflation, whenever there is low growth and a very high inflation. Coming to question number 14. Which does the IS-LM model represent? The IS-LM model represents IS curve and LM curve. Is it the interaction between fiscal and monetary policy, the stock market equilibrium, the trade balance, or the labor market? And the right answer will be it is an interaction between fiscal and monetary policy. The IS curve is a goods market and the LM curve is a money market. So the goods and the money market intersection gives equilibrium in the interest rate and income. So IS and LM model represents the interaction between the fiscal and the monetary policy. In Keynesian theory, an increase in investment leads to what? An increase in investment leads to what? A decrease in income? It has no effect. A multiplied increase in income, or only inflation? What is it? Decrease in income, it has no effect. A multiplied increase in income, only inflation. So Keynesian theory says it is multiplied increase in income, known as the investment multiplier. Each rupee invested circulates through consumption, raising the total income. Coming to question number 16, which of these is not part of money market? Treasury bills, commercial papers, certificates of deposit, or the equity shares? Which of these is not part of the money market? So money market instruments are short-term instruments, that is having a lesser than 1 year period. And the answer is equity shares, because shares belong to the capital market. Treasury bills, commercial paper, and certificate of deposits belong to the money market, and equity shares belong to the capital market. Coming to question number 17, a yield curve that slopes upwards generally indicates what? A recession, a high future interest rates, a lower long-term growth, or a stable inflation? What does a yield curve that slope upward indicate? A recession, higher future interest rates, lower long-term growth, or a stable inflation? It is a higher future interest rates. That is, upward slope means investors expect higher inflation and rates in the future. Normal in the growing economies. Whenever the yield curve goes upwards, then there are chances that higher future interest rates will happen. So which market instrument is issued at discount and redeemed at par? The treasury bill, the debenture, the preference share, or a bond? Which is issued at a discount and redeemed at par? The treasury bills are short-term government securities, which is issued at a discount and redeemed at par by the investors. Which body regulates India's money market? The SEBI, RBI, IRDI, or the Ministry of Finance? And the right answer will be it's RBI. RBI sets rules for call money, the commercial papers, and ensures liquidity of management. So RBI sets rules for call money, the commercial paper, and ensures liquidity management. So it is the one that regulates India's money market. Coming to question number 20. An inverted yield curve signals what? A rising inflation, economic expansion, potential slowdown or recession, or the fiscal surplus. Now we went for an upward curve. Now this is the downward curve or the inverted curve. So it's just the opposite. The answer will be C, potential slowdown or recession. When short-term rates exceed the long-term one, markets anticipate weaker growth ahead. So that is when there you have an inverted yield curve. Which of the following is not a function of money? Medium of exchange, store of value, source of credit, or a unit of account? Medium of exchange, store of value, source of credit, or a unit of account? And the answer will be option C, source of credit. Credit is created by banks. Money itself facilitates exchange and valuation. So source of credit is not a function of money. Which component is excluded from the M1 money supply? Which component is excluded from the M1 money supply? Currency with public, demand deposits, the post office savings, or the time deposits? What is it? What is M1 money? M1 money is also called the narrow money that can be immediately withdrawn or immediately available for transactions. So automatically the time deposits are not a component of M1 money. Coming to question number 23. When RBI sells government securities in the open market, it injects what? It injects liquidity, absorbs liquidity, expands money supply, or reduces the interest rates. Whenever RBI sells government securities in the open market, it absorbs liquidity. That is, the sale of securities in the condition banks pay the RBI, wherein less cash for lending, and it tightens the liquidity. Whenever RBI is selling a government security, banks buy it. When the banks buy it, they do have less cash for lending, and it automatically tightens the liquidity. So RBI absorbs liquidity by selling government securities in the open market. And question number 24. The Monetary Policy Committee targets the money supply growth, the inflation rate, the employment generation, or the fiscal deficit. What is it? Target. The Monetary Policy Committee always targets the inflation rates. That is, it keeps the consumer price index inflation at 4%, plus or minus 2%. And it is always chaired by the RBI governor. You also know that there are 6 members in a Monetary Policy Committee, of which 3 come from the RBI and 3 is appointed by the government. And in that case, the governor have an extra vote if there is any decision to be taken and if the decision comes and falls in a tie. Question number 25. Which of the following is a quantitative instrument of monetary policy? Moral succession, repo rate, margin requirement, or credit rationing? Which of the following is a quantitative instrument of monetary policy? Moral succession, repo rate, margin requirement, or credit rationing? And the right answer will be repo rate. Quantitative tools affect total volume of credit. Qualitative tools guide sectoral flow. So in this condition, it is repo rate, which is a quantitative tool. Coming to question number 26. Which bank instrument represents short-term borrowing by corporates without collateral? Which bank instrument represents short-term borrowing by corporates without collateral? Is it the commercial paper, the debentures, the term loans, or the treasury bills? Whenever a corporate is issuing something, it is going to be a commercial paper, which is an unsecured promissory note issued by highly rated firms for a period lesser than or equal to 1 year. So the maximum period is 365 days. So whenever a corporate is issuing it, it is a commercial paper. It is an unsecured promissory note. Coming to question number 27, what does moral suspicion mean in RBI operations? What does moral suspicion means in RBI operations? Is it compulsory directive, persuasion guidance to banks, penal rate adjustment, or the legal enforcement? It is a persuasive guidance to the banks, where an RBI use persuasion rather than a mandate. Example, urging banks to lend to priority sectors. So this is pursuing guidance to the banks. The call money market deals with what? Long-term credit, overnight funds between banks, foreign exchange, or the retail deposits. And the answer will be B. It is overnight funds between the banks, which is used for very short-term liquidity balancing. And the rate is called the call money rate. Call money is the overnight funds between the banks. If inflation exceeds interest rates, the real interest rate becomes positive, negative, zero, or constant. What is it? As an answer of common sense, whenever the inflation exceeds interest rates, the real interest rate becomes negative. Real rate is equal to nominal minus the inflation. So negative real rates discourage savings. Coming to question number 30, the Fisher equation relates to what? Money supply and prices, nominal rate, real rate, and inflation, income and consumption, tax and expenditure. The Fisher equation relates to what? And what is a Fisher equation? Fisher equation is I is equal to R plus pi. So that is nominal interest is equal to real interest plus expected inflation. In this case, the answer rate is B, nominal rate, real rate, and inflation. Question number 31, which rate acts as a floor for overnight money market? Is it the repo rate, the reverse repo rate, bank rate, or the MSF, the marginal standing facility? And the right answer will be the reverse repo. Banks lend to RBI under the reverse repo, earning minimum assured return. So when the GDP rises, question number 32, when GDP rises without equivalent employment growth, it's called jobless growth, stagflation, hyperinflation, or a productivity paradox. What do you call it? It is jobless growth. When efficiency improves but job creation lags, it is seen in a tech-driven sector. Whenever there is jobless growth, it is the condition in which when GDP rises without equivalent employment growth. It's called jobless growth. Question number 33. Which of the following best defines the financial repression? Free capital movement, excessive control on interest rates and credit, liberation of markets, or inflation targeting? Which of the following best defines financial repression? And the right answer will be option B, excessive control of interest rates and credit. Repressions occur when government caps deposit rates or directs credit to itself. This is the condition when the government has a say in the deposit interest rates or takes the amount towards himself to the RBI. Question number 34. What happens when RBI reduces the statutory liquidity ratio, SLR? Banks must hold more securities. Banks get extra funds to lend. There are credit contracts, or the inflation falls. What happens in this condition? When the SLR is reduced. SLR is a fund wherein each and every bank should have a certain amount with RBI. Whenever RBI reduces it, the banks get extra funds to lend. Lower the SLR, more lendable resources. So that's a expansionary stance. Whenever banks have more money to lend, that's the best time. Question number 35. Which of these is not a source of money supply? RBI credit to government, net foreign assets, public borrowing, or a government taxation? Which of these is not a source of money supply? The right answer will be option D, government taxation, wherein taxes redistribute existing money and new money enters via a credit creation. Coming to question number 36. When GDP increases due to higher prices, higher price level, but not output, it reflects what? It reflects real growth, nominal growth, deflation, or a productivity rise. It reflects real growth, nominal growth only, deflation, or a productivity rise. So whenever GDP increases due to higher price levels, but not outputs, it reflects the nominal growth only, wherein real GDP adjusts to the inflation and nominal does not. Real GDP adjusts to the inflation, wherein the nominal growth does not adjust. The output gap measures the difference between potential and actual GDP, fiscal deficit, import or export gap, or the investment and savings gap. What is the output gap? Output gap is the difference between potential and actual GDP. So wherein the positive gap is overheating and the negative is a recessionary condition. So this is what is a output gap. Question number 38. When banks park funds beyond CRR or SLR safely with the bank, it's called what? The reverse repo, open market sale, MSF, or way and means advance. When banks have an excess fund, they park it with the RBI. What is it called? It's called the reverse repo, wherein the banks earn a interest from RBI. And reverse repo absorbs excess liquidity temporarily. Coming to question number 39. Which statement on monetary transmission is correct? Repo changes instantly and alter the lending rates. Always one-to-one response. Depends on the banking structure and expectations and works only for foreign banks. What would be the right answer? Which statement on monetary transmission is correct? And it's option C. It depends on the banking structure and expectations, wherein the transmission lag varies by liquidity, competition, and policy credibility. So monetary transmission depends on banking structure and the expectations. A tight monetary policy implies which of these? The answer is visible. It is lower interest rates, it's higher policy rates, and the restricted liquidity. It is used to curb inflation, reduce credit flows, and raise the borrowing cost. Let's go to question number 41, wherein we will be going for a case study question. We do have two case studies. Question number 41 to 45 will be case study 1, and question number 46 to 50 will be case study 2. So Case study 1. In April 2025, the RBI increased the repo rate by 50 basic points to control rising inflation. Banks began tightening credit as the cost of funds increased. Government bond yields rose and the credit growth slowed during the quarter. This is the case study. So what happens? When the RBI raises the repo rate, what is the most likely immediate impact on the commercial banks? Lowering borrowing costs from RBI, increased borrowing costs from RBI, higher deposit inflows at the same rate, or a cheaper credit for corporates. What happens? Whenever repo rate hike is made, the funds are costlier for the banks, discouraging lending and reducing the liquidity. So, excuse me. So the answer will be increased borrowing cost from the RBI. The answer is B, increased borrowing cost from RBI. When the repo rate increases, the borrowing cost also increases. Question number 42. If the RBI simultaneously increases the CRR ratio, what happens to the market liquidity? If the CRR is also increased with the repo rate, what happens to market liquidity? Does it increase? Does it decrease? It will not have any changes in liquidity, or liquidity depends on the inflation level. What happens in this case? And again, if the CRR is also increased, the liquidity decreases. Coming to question number 43. During such a tightening phase, how do bond prices generally move? It rises because of the yield rise. It falls because the yields rise. It stays constant, or rise because there is demand for bond increases. What is the answer? Bond prices generally move inversely to the yields. So when the interest rate goes up, existing bond loses value. So the answer is falls because of the yields rise. Bond prices move inversely to the yield. So when there is a hike in the interest rate, existing bonds lose their value. Question number 44. How does sustained high interest rate policy affect the bank profitability in the short term? It increases profitability due to wider spreads. It reduces profitability due to lower credit offtake, has no effect on profitability, or improves the fee-based income sharply. How does sustained high interest rate policy affect the bank's profitability in the short term? What happens? It reduces the profitability due to the lower credit offtake. Credit demands fall when the borrowing cost rises, and interest income automatically have a slow growth. So whenever the interest rate is high, people do not borrow money. In that condition, that reduces the profitability due to the lower credit offtake. Question number 45. An RBI statement says it stands as withdrawal of accommodation. What does this mean? RBI is increasing the liquidity. RBI is neutral on liquidity. RBI is reducing liquidity support, or RBI is cutting rates to spur the growth. What does withdrawal of accommodation mean? Withdrawal of accommodation means the RBI intends to tighten liquidity and maintain higher rates. So RBI is reducing the liquidity support. In this condition, RBI intends to tighten the liquidity and maintain higher rates. Coming to case study number 2, we will have 5 questions in this also. In June 2025, the Indian rupee depreciated sharply against the US dollar because of rising crude oil prices and heavy foreign portfolio outflows. The RBI intervened by selling dollars from its reserves to stabilize the exchange rate. Meanwhile, importers faced high payment obligations, while exporters gained short-term advantage. This is the case study. And now let's go into the questions. So what happens? A sharp rupee depreciation is most likely to cause which of the following effects? We have discussed this earlier also. Imports become cheaper and exports costlier. Imports become costlier and exports become cheaper. Both imports and exports become cheaper. There is no impact on trade flow. And I think everyone knows the answer because we have already discussed this. Whenever there is a weaker rupee raises import costs but makes exports more competitive in the global market. So the answer is B. Imports become costlier and exports become cheaper. Coming to question number 47. India's exchange rate policy can best be described as which type of system? Is it the fixed exchange rate system? Is it a free float system? Is it a managed float? That is a system of market determined rates with occasional RBI intervention. Is it a managed float system or a dual exchange rate system? Which of this is it? The option is, the correct answer is option C. India follows a managed float regime where the RBI intervenes to avoid excessive volatility. Coming to question number 48. When the RBI sells US dollars in the foreign exchange market, what is likely impact on rupees liquidity in the domestic banking system? There is an increase in liquidity. The liquidity decreases. Liquidity remains unchanged or depends on the import demand. What happens? There is a decrease in liquidity. The dollar sales absorb rupee liquidity because RBI takes rupee out of circulation to purchase foreign currency. Coming to question number 49. I hope you would have subscribed the channel by now. If you do like, give me a thumbs up. Thank you. In June 2025, question number 49. Large foreign institutional investors, that is FII, outflows tend to impact the rupee in which way? Does it appreciate the rupee value? Does it depreciate the rupee value? Does it stabilize the rupee automatically or have no impact under the FEMA? It automatically depreciates the rupee value. FII outflows increase demand for foreign currency and reduce demand for the Indian rupee, which causes depreciation. And for the final question in this session, an exporter entering into a forward contract to sell USD after 3 months is primarily aiming to what? Speculate on future currency movements, hedge against exchange rate risk, increase capital inflow under the FEMA, or earn interest on dollar holdings. What will be the right answer? And what are forward contracts? These forward contracts allow exporters to lock in future exchange rates and avoid losses from the rupee appreciation. So it is a hedge against exchange rate risk. So that is all from this session. We shall meet up in the next session, that is module C of IE and IFS. Jai Hind, Jai Bharat. Do like, share and subscribe the channel. Brilliant backers. This is Nishant signing off. Jai Hind.